Welcome to Trader TV, your insight into trading for professional investors. I'm Dan Barnes. Joining me today is Ricky Goddard, Head of EMEA Credit Trading at Schroders. Ricky, welcome to the show.
Hi Dan, thanks for having me.
Today we'd like to run through what's been happening at the start of Q2 and of course also what's been happening at the ICMA. Last month we saw ICMA issue new guidance on to how dealers distribute bond prices. Can you tell us first of all why they did that?
Yeah, sure. So, really this initiative was designed to be a guide for best practice rather than a rule. So the aim is to lay down some ground rules for what's expected with respect to price and axe distribution and the labels that are attached. From the buy side perspective, the main ambition really was to put in place some form of standard terminology of what a market run is, what an axe is, what a two-way is. And really one of the things that we're trying to eliminate is this two-way axe that we're kind of seeing being streamed to electronic trading platforms or sent in directly to order management systems, when in many of these instances, in fact, what we're dealing with are stale IOIs or just people trying to advertise that they're actually involved in a particular bond. So, we opened up this discussion to a broad selection of buy sides, sell sides and trading venues to try and find a solution. The kind of end aim is that for me and for my peers and the guys on my desk, we're able to better direct trades towards people who actually have axes or are actually working IOIs in particular bonds, and therefore we have less information slippage, less time delay, and also communications can take place with just a little bit of degree of certainty.
Yep.
A little bit more confidence in what the outcome may be potentially. I think certainly when I was working on the sell side and, from every sell side dealer that I speak to now, they want you to ask fewer and fewer dealers or inquiries. And that's something that I'm okay with, but I need to know who to go to in the first place. So that's really the sentiment that's behind this entire initiative.
How do you see that potentially affecting execution quality and the way that people execute into the market?
I think realistically, it should probably lead to slightly more voice conversations taking place. Like for instance, when I'm looking at a bond at the moment and I can see that 5 people are showing an axe in 3 million, then it smells to me like an electronic RFQ, because you think, okay, 5 people are axed. There should be a bond that trades well on RFQ. And then, you send an RFQ and you might get 3 responses, and 2 of those are from people who weren't on the axe. And, you get some IB saying, hey, that bond that you're inquiring on, I had an IOI in this 3 days ago. Maybe I could make a call on it. And obviously that lets you down because, you're trying to push trades to the execution methods that are most efficient for you on the desk when you consider all the data you have at your disposal. For me, if I have a 20 to 30 million block to work, I'm always going to get on the phone and discuss that with somebody. But there's a reasonable amount of business that needs to be conducted electronically because of the size of the business or the liquidity of the bonds that it's in, or just because of the time sensitive nature. And so for those types of trades, you really need good quality data.
You mentioned these guidelines, not rules. How will we know if they're being followed?
That's quite difficult to capture. We don't really have the tools in place to be able to measure, the responses. There isn't the ability to mark data in the trading platform or in any of the axe distribution systems to say whether the axe was real or stale or to give it any kind of quality ranking. So I think it's, a qualitative thing rather than cold hard data. I have heard that some of our peers are looking to build some form of review of this into their broker review process, which I think is quite interesting. And it's certainly something, that I'll be looking at. But I think ultimately what we're trying to achieve is just to get across the message. This is what's expected from us. So ultimately, if you're a sell-side trader or a sell-side salesperson or a trading venue, this is what the buy side is expecting to see. So therefore, people who innovate in this area, whether it be trading platforms or whether it be banks or brokers that, seek to find alternative ways to make their data more accurate, then we're far more likely to flock to them for our trades, and especially the trades they want to see, which is, the bigger ticket, less dealers in comp type business.
And is there potential for this to lead to a certain amount of automation of low-touch trades, for example?
The type of house that we are and the type of funds that we run, it's not an obvious execution style for us. But in some circumstances, whether it's large inflows or outflows that, might not constitute a huge amount of capital, but actually just take into account, maybe 100 lines or 150 lines, some form of automation helps you speed up the trading of those orders. The better quality data you have, then obviously the more confident you are to use those protocols. I'm a big believer in the fact that if you're looking to automate your trading, one of the biggest factors you have in credit because of the liquid nature of the market is you need to know who is axed or who's involved in that bond. And that's quite difficult. You might have 20 banks streaming a price and they're all within 10 to 15 cents of each other. But realistically, only 7 or 8 will actively trade that bond. I think that's one of the issues that we're dealing with. So we're really looking for people to kind of differentiate themselves away from the pack. And then obviously that helps us build these automation protocols to send tickets to those who are deserving of seeing them, which, then helps them with their ETF products and the portfolio trading that all comes off the back of electronic trading. So it should be a win-win for everybody involved.
Just looking at trading conditions over the start of the quarter, April to early May, obviously last year we had a big sell-off in March. How are things this year, and how is that affecting execution quality from your side?
It was quite an interesting time because people started to become concerned about inflation. We saw a really strong performance in CDX high yield in the US that has a strong energy component. And that was in part fueled by these inflation expectations. So we saw a reasonable amount of volatility in the underlying rates market, which of course led to some reasonable intraday volatility in credit markets as well. Clearly nothing like what we saw, kind of March, April time last year.
Yeah.
But that became the big concern for the market. How will the credit market respond to higher rates or steeper yield curves, in the government space? So, how we deal with that going forward is obviously the big question on everyone's mind. And at the moment, that's kind of dampened down a little bit. And, we're seeing relatively stable conditions. Stock markets performed fairly well. So the underlying tone was a good tone and sentiment was strong. We didn't see any material change in trading dynamics. And, we were able to execute pretty much in line with how we usually are.
And then from a strategic point of view, how are you focused at the moment on delivering best execution for your investors?
So one of the things we've just finished is an audit of all of our trading platforms. So looking at the protocols we use, whether it be, RFQ, how we select the brokers, whether it be automation, what rules do we assign? All the platforms are slightly different. So constantly assessing, what protocols does each platform offer you? Does anyone offer anything that's slightly different to the pack? Should we be considering that when previously we haven't used that platform much in the past? So that's an important process. And we tend to do that, once or twice a year. Another thing we've been looking at is the new issue process. Access to new issue is an incredibly important, way for us to add risk to the funds, especially if you run, large funds. You need to have good access to primary. So, electronification of that market is incredibly important. But it's not just the electronification, it's also how do we then assess the allocations that we get? What trends are we seeing in the market? Is there any data that we can pass on to the PMs that in the end rewards our end investors? So that's a big thing that doesn't necessarily impact execution at the point of trade. Over a period of time, you're hoping that it can feed back into performance.
Ricky, that's been fantastic. Thank you so much.
Thanks, Dan. Thanks for having me.
I'd like to thank Ricky for his insights today, and of course you for watching. To catch up on our other shows or to subscribe to our newsletter, go to tradingtv.net.